The following podcast by Fusion Family Wealth, LLC, Fusion, is intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Please see additional important disclosure at the end of this podcast. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.
Welcome to the Crazy Wealthy Podcast with your host, Jonathan Blau. Whether you're just starting out or are an experienced investor, join Jonathan as he seeks to illuminate and demystify the complexities of making consistently rational financial decisions under conditions of uncertainty. He'll chat with professionals from the advice world, entrepreneurs, executives, and more to share fresh perspectives on making sound decisions that maximize your wealth. And now, here's your host.
Hello, everybody. This is Jonathan Blau, and I'm proud to be bringing to you the inaugural episode of our podcast called Crazy Wealthy. I talk to you today about a little bit about who I am, my background, and what led to the idea of coming out with this podcast and what the purpose of it is and what we hope to allow our audience to gain by becoming consistent, hopefully consistent listeners. So I grew up in a town called Bayside, Queens, in a middle-class family. And unfortunately, my dad, when he was a kid, had rheumatic fever, which caused him to have a mitral valve issue and ultimately have a stroke when I was 11. He became paralyzed and unfortunately lost him when I was 13. So I was kind of forced to make a decision at a crossroads, to kind of realize that I had nothing to fall back on financially in life, and either sink or swim. And fortunately, I was able to swim. But the reason I start with that story is I today find myself in a position as the CEO of Fusion Family Wealth, where we've been able to help many families learn to protect and grow their wealth over the years. And by doing that, we've actually been able to build wealth for our own family. So there's nothing in my professional life and personal life that's been more satisfying than being able to accomplish those things. And having been on both sides of the wealth spectrum, growing up where I didn't have the freedoms to pursue things because of the inability to access money as a tool, and now having been on the other side where I'm able to give my family and help my clients make sure that they can access that tool successfully and consistently, that'll help me to come to you from both perspectives with a podcast. And what we'll try to do is we'll try to illuminate and demystify the complexities involved with financial decision making. So when we make decisions about money, particularly under conditions of uncertainty, we're influenced, unfortunately, by what are called biases. And what these biases are really systematic errors in judgment. And they're embedded in human nature. So no matter how smart we are, no matter how well educated we are, we tend to make poor decisions when we are faced with uncertainty in money. And so the good news about that is they are systematic errors, meaning they're identifiable and they're predictable. Behaviors tend to be repeated. So once we learn what those behaviors are and how they're influencing us to make decisions that are against our best interests, we can correct them. And so that's what this podcast will attempt to do by identifying them, not just via my podcast and my explanations, but actually inviting guests from both the financial industry, the advice industry, accountants, attorneys who advise wealthy families, and hear their stories, their money stories, their clients' money stories, and experientially learn from them what they've done as it relates to making some errors in judgment about money or advising their clients who've made those errors. So it'll be nice to hear some real life experiences. Generally, when we talk about biases, there are two types categorically. There's emotional biases. Two of the most prominent ones are what are called loss aversion bias and regret aversion bias. So loss aversion bias deals with the idea that we are 2 times more sensitive to the pain of a loss than we are to the pleasure of an equivalent gain. So when we make decisions in life, there's an asymmetry between the importance we put of avoiding a loss versus pursuing a gain. And as investors, what happens is it's why many people are afraid to invest in as owners of companies, or what's more generically referred to as the stock market. And it's because the frequent, unpredictable as to timing and magnitude of declines that are associated with investing as owners of companies don't appeal to our human nature instinct to avoid losses. And we're particularly sensitive to short-term moves. So we have what's called myopic loss aversion. We're nearsighted when it comes to losses. We look to avoid losses in the short term. And so what we need to do to succeed, particularly when it comes to investing, is to seek out strategies that look to maximize our long-term wealth, particularly the ability to grow our money in the face of inflation. But what we really innately look for is not those strategies. We look for strategies that minimize the chance of short-term loss and maximize the chance of short-term pleasure. And those are exactly the opposite strategies than the ones that we need to maximize long-term wealth. So for example, we might look to have too much of our money in cash, money markets, bonds, and gold in the short run, so that we minimize our chance for long-term, for short-term loss. But those investments, bonds and gold and so forth, also minimize our chance for long-term wealth building. So we'll talk about how to address loss aversion bias, identify it, and overcome it. And we'll also hear from guests who have experienced those biases and how it's influenced decisions that weren't really in their best interest in the long run. So emotional biases like loss aversion and regret aversion are the two most common. Regret aversion is actually much more painful than loss aversion, because long-term regret never goes away. So it's one of the most painful emotional biases that we have. And the problem that it creates is that if we make an investment or a financial decision where the outcome didn't reflect what we wanted, it became so painful to us that in order to avoid that feeling of regret in the future, we shy away from engaging in any activity. So if we had a bad experience in the stock market at one time or other, maybe we chased technology stocks in the late 1990s, what happened to us is we stopped investing in stocks. We didn't admit that the error was the fact that we over-concentrated and weren't any longer investing. We were speculating on technology stocks or dot-com stocks. And so that's what caused us to lose. And that regret was so powerful that we said, I'm never investing in stocks again because stocks don't work. I'm just going to revert to what's called status quo bias. If I just leave the money in cash, leave it the way it is, status quo, I will never have to face the regret of a technology bubble bursting or anything like that again. And so people will accumulate cash, and that becomes a very dangerous financial decision for the long term. So the other kind of bias outside of emotional is called cognitive. So cognitive biases are really just systematic errors that reflect faulty reasoning. So one example is called representative bias. If we see a coin flip, for example, and it's flipped 8 times, and we see 5 heads and then 3 tails, we're likely to think that maybe the next 2 will be tails, particularly if it's going to be a 10 flip series. And in reality, that's because that represents what we think coin flip should look like, 50-50 outcome. But there's something called the law of large numbers. So if we had, the more coin flips that we have, the more likely we are to see 50-50. So if we have 100 coin flips, we're likely to see the outcomes be closer to 50% heads or tails. But we don't really appreciate the law of large numbers when we're thinking about things like probability, because it's our reflexive mind, or our system 1 mind, that's making decisions based on what we think represents the stereotypical outcome that we should expect. So that's one example in a coin flip. And it's the same thing, by the way, with representative bias. It's why people or investing might chase performance of a hot mutual fund or money manager. They think because it's had 3 or 4 good years in a row, that relative to other funds, that it means that it's likely to have another 3 or 4 good years in a row. When in fact, oftentimes the opposite is likely, because while straight good performance relative to a benchmark seems to indicate that we can expect it going forward, what it really usually does is it says, gee, if this manager outperformed for the last 3 or 4 years, there's something called reversion to the mean. And competing with all these other managers, they're likely to underperform for the next 3 or 4, so that the average performance kind of equals the performance of the market over time. And so representative bias in that way can actually hurt investor choices based on our reflexive or system one mind, which basically just looks for shortcuts in decision making, and those shortcuts often lead to faulty reasoning. And representative bias is one example. Another example is familiarity bias. We tend to like to own things and invest in things that we're familiar with, thinking irrationally that those things will help us more and hurt us less always than things that we're not familiar with. And what that leads to is it leads to over concentrating in a smaller pool of choices, whether it's investments or businesses or anything that we're engaged in, and it actually leads to increased risk. So again, familiarity bias and representative bias, 2 examples of faulty reasoning. Then one of the things that's another issue when it comes to decision making, particularly when it comes to money, is we tend to be overwhelmed with a tremendous amount of information, particularly 24-hour financial news cycle, the internet, and all the data available. And what we fail to recognize is that data is not knowledge, and knowledge is not wisdom. Wisdom is an accumulation of experiences that lead us to be able to understand how the data and the knowledge we've acquired can lead to better decisions. And by looking at all of the information that we have, investors seem to feel like, wow, I'm equipped. I don't need to have any help. I have all this data. I can do it myself. One of the things that's important that we hope to get across to everybody who listens to the podcast when it comes to behavior and investing success and success with money decisions is 1 part intellect, what we know, and 99 parts temperament, what we do. So if you have the smartest, most well-educated person in a room of 10 people, and you have someone who never went past high school, and then you have people who are successful entrepreneurs and people who don't have to work, they're all equally likely to sell out every investment that they own that's not a dot-com investment, to chase the dot-com bubble in 1999, and they're equally likely to sell out some or all of their portfolio in the face of the 2008-9 credit crisis, in fear that their stock portfolio is about to implode because of what was going on with the economy. And so human nature is immutable. It doesn't change, and it doesn't discriminate between old and young, rich and poor, educated and less educated, man and woman. We're all prone to make the same exact mistakes. So again, the important thing to take away from that is that good investment and money decisions are based 1 part intellect, only what we know, and 99 parts temperament. One of the examples I like to give is if we fly on an airplane, we typically don't go to the pilot and interview them. We don't want to ask and read about how the controls in the cockpit work in case there's an emergency, so that we can take over and get in touch with the air traffic controller and start taking control. We don't do that because of what I call accessibility bias. That information is not easily accessible or understandable. But when it comes to investing, we somehow think because that information about valuation of companies and price to earnings ratios and all of these sorts of things, money manager performance versus others, we think because that information is accessible, that somehow having that information will enable us to become successful investors. It won't. any more than having the information about the controls in the cockpit would enable us to successfully land an airplane. So it's important to understand that just because the information is available, data is not knowledge, and knowledge is not wisdom. The other thing that we like is we like certainty. So when it comes to certainty, what the challenge in the industry that I'm in, the advisory, the wealth advisory industry, is that the investor comes to the table looking for as much certainty about their financial future as they can possibly garner. And the industry, unfortunately, generally tends to address that need for certainty by handing what I call the illusion of certainty back to the client. What I mean by that is they will tell the investor how many analysts, security analysts they employ, who will tell them which industries and companies are about to perform better than the other industries and companies. They'll tell them how many economists they employ so that they will be able to tell the investor when the recession is likely to come, and use that information to get them in and out of the investment markets opportunely. And so economic forecasting can't consistently be done accurately. Gaining a timing advantage over the market can consistently be done accurately. So what we do to help investors, and we hope to help the podcast listeners gain an understanding of, is that you need to learn to make consistently rational decisions given a constant state of uncertainty, rather than being handed the illusion of certainty, because that's only a Band-Aid, and ultimately the money decisions will be negative when one has the illusion of certainty. And a corollary to that is when we watch the financial news, one of the things I always hear that's a little bit frustrating is they talk about the market hating uncertainty, that given what's going on with the war in Ukraine, and given what's going on with the Federal Reserve and their decisions that we don't yet know the outcome of, to raise interest rates, when they'll happen and what the magnitude will be, the market hates uncertainty, they say. And what that implies is that at various times there can be more or less certainty, and that's just a concept that doesn't make any sense. So as an example, there are studies that have looked at how many times the word certainty and financial certainty appear in the newspaper, and based on those kinds of studies, it's been said that the period of time in the last 20 years or so that we had maximum certainty or minimum uncertainty was the period right before the September 11th terrorist attacks, like on September 10th, and the period right before Bear Stearns and Lehman Brothers went out of business during the financial crisis. In fact, I would say on September 10th of 2001, we probably were never more certain. There was probably never more certainty that we were about to have a terrorist attack. The only thing that was different is we were oblivious to that risk on September 10th, but we didn't have more or less certainty on September 10th. And so it's very important to understand that that when you're watching the media and the news, their job is to not advise us on how to make better financial decisions, but to sell advertising and to get you to click on their stories. It's always going to be sensationalized. So falling for the narratives of things like more or less certainty can cause us to abandon our plan for the wrong reasons at the wrong time. The illusion of control to us is much more persuasive than the reality of uncertainty. So we like to kind of do things where we have a hand in it, thinking that the outcomes will be better if we're involved. And in investing in particular, when human beings who are emotional and hormonal and cognitively subject to make decisions using rules of thumb instead of lengthy reasoning, when they get their hand involved, when we get our hand involved, usually the outcomes are going to be far worse, not better. So that's something that people have to kind of face. It's hard to accept that, and particularly hard to accept if we've achieved success in other areas of our lives. If we've achieved success academically, if we've achieved success in our careers, it's hard for us to accept that us not being involved will somehow in any endeavor lead to a better outcome. One example, and one reason that happens is something called attribution bias, or SUS, where we actually influence the outcomes, or believe we influence the outcomes solely because of our skill set and our abilities, meaning that we don't really give a fair assessment of how much luck may have played a role. And luck is almost always present in the outcomes of decisions. So it's important for us to understand that, and by the way, luck and risk are basically the same thing. Luck is just when an outside factor influences the outcome and the outcome happens to be good. And risk is when an outside factor influences the outcome that happens to have been bad. And in life, what we tend to do is we tend to attribute much more skill, particularly if we're used to being successful in our other endeavors, to the outcomes that we achieve when they're good. And we tend to attribute bad luck to the outcomes when they're bad. So if we can reframe how we think about things, it would help us to make fewer mistakes and have an open mind about what we can control, and maybe getting outside help in informing our decisions, and not thinking we can and need to control everything. So we'll talk about the role of luck. And one of the things I like to say is our experience in the world accounts for about 0.0001% of everything that's ever happened, yet it accounts for 80% of how we think the world works. So those all relate to our need for control and the illusion of certainty. And we'll talk about how to kind of get around and overcome those. So what we're going to do is we're going to come to everybody with this podcast on a monthly basis. We're also going to have a shorter podcast that comes every 2 weeks called Fix It Fridays. And what Fix It Fridays will do is they'll highlight a bias that we have, either cognitive or emotional, or something that's going on current event-wise that investors should be aware of, how it can influence them to be making decisions that might be against their interests. So not only how to identify it, but how to overcome it. And those will usually be maybe 3 to 5 minutes of just me coming out and sharing our thoughts about those with you. And then once a month, we'll have the traditional Crazy Wealthy podcast, which should be anywhere from 30 to 60 minutes long. And we welcome you to like and share our podcast. You'll be able to find it on our website, which is fusionfamilywealth.com, under the podcast section. And you'll also be able to find it on all the major outlets where podcasts are available, from Spotify to Apple, etc. So you can also find us at crazywealthypodcast.com. So thanks for listening. We really look forward to engaging with you on a monthly basis and hearing the feedback. Hi, honey.
Hey, what's up?
I just finished our inaugural podcast for Crazy Wealthy, and excited to get it off the ground. So that's what's up.
So tell me what you think you're going to be doing in this whole podcast.
Well, like I said in the beginning, we want to illuminate and demystify the complexities that are involved with financial decision making, and you know how we do that. We talk about all of the innate human nature-based behaviors that cause us to go off in directions that are against our financial interests.
Oh, believe me, I know how much you talk about this. But I'm so excited for the rest of the world to hear all the bits of knowledge that you have. And I'm excited for someone else to be hearing about this all the time besides me.
Well, so am I, to be honest with you, because
And
hopefully I won't hear the real-time criticism then.
That's true. To be honest, I have no time for this today. I'm off to my next activity. So you keep telling the world all about behavioral finance.
Okay, and do me a favor, just start putting into practice some of the things I teach the world.
You got it. Start taking out the garbage on Sunday night and you have a deal. Bye, honey. Love you.
Love you.
Thank you for tuning in to another episode of the Crazy Wealthy Podcast. For more insights, resources, and to sign up for our newsletter, visit crazywealthypodcast.com. Until then, stay crazy wealthy.
The previous podcast by Fusion Family Wealth, LLC, Fusion, was intended for general information purposes only. No portion of the podcast serves as the receipt of or is a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation. Neither Fusion's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Fusion is engaged or continues to be engaged to provide investment advisory services. Fusion is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the video content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Fusion is engaged or continues to be engaged to provide investment advisory services. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.